We're going to talk about making better decisions, how to evaluate decisions, how to make better decisions. And first I'm going to start off with a couple stories about decisions and how they were perceived. So I'll take you back a few years. Super Bowl 49, it's 2015. It's the Seahawks versus the Patriots. The Seahawks are down by 4 points. There's 20-something seconds left to go in regulation. They are on the 1 yard line, so they only have 1 yard to go to get a touchdown. They obviously need a touchdown because they're down by 4. They've got one timeout left. It's second down. They've got the star running back, Marshawn Lynch. And everybody expects the coach, Pete Carroll, to call for a handoff to Marshawn Lynch to run to the end zone. And the play call comes in, quarterback takes the snap, and he drops back instead of handing it off. He throws to the end zone, and it's intercepted. It was called the worst play call in Super Bowl history because the Seahawks lost the game. And but the question is really, was it the worst play call in Super Bowl history? Was it even a bad call? What's the chance of that ball being intercepted? And did the coach make the correct call based on the statistics? Well, turns out there were 66 pass plays similar to that during that season. Do you know how many were intercepted? 0. Over 15 years, only 2% of those pass plays were intercepted. So arguably, it was a good call because it was the only way to get 3 tries at the end zone because they only had 1 timeout, and that would have stopped the clock if it was incomplete. Interestingly, just a few years later in the Super Bowl, the Eagles were playing. There was 38 seconds left in the first half. They had 4th and 1, so they only had 1 try, and instead of running it in, they called a pass play. Their pass play worked, and it was called by some magazines a triumph of modern leadership. So 2 very different, similar choices or play calls, different results, and hailed by the popular media in very different respects. So we're going to come back to that a little later on in the presentation, give it a formal name, but I think that this speaks to some of the problems that we have as a popular culture in terms of evaluating decisions. And in this presentation, we're going to talk about better ways to evaluate decisions and how to make better decisions. So if you like what we're saying here today, and you are interested about reading more, go to alger.com. On the Insights section, there's many different papers and articles and podcasts that we've done about behavioral finance. So why are we focusing on behavioral finance? Well, we're taught in traditional finance, if you go to school or you read a textbook about it, that investors behave rationally. But we know that us humans are not always rational, and we have a whole bunch of biases that work against us that hinder our decision making. But there are techniques that can help us make better decisions, and I'm going to go through 3 different techniques or concepts that can help you make better decisions. And then with respect to your investments, I'm going to go through some very specific potential things that you can do to make better decisions in investing. Okay, so first off, there is a problem. This chart depicts in the dark blue line the investor return in investing in mutual funds. But the problem is that those mutual funds actually did much better than the return that the investors got from investing in those mutual funds. There was over 170 basis point gap between how the mutual funds did and what investors actually received from those mutual funds. And the part of the problem here is the timing and the decision making of investors. Sometimes they buy high and sell low, and that could cause underperformance. And I think part of the reason for this is these biases and the way the brain is set up. So traditional finance, again, people are rational, and stock prices are efficient because we all act with objective knowledge and make rational decisions. But we know through the work of Daniel Kahneman and others in behavioral finance that people actually have cognitive and emotional biases. They don't have perfect judgment. It's subjective based on their experiences and their makeup. And all these biases are reflected in stock prices such that the prices aren't efficient, and there's room to outperform or underperform depending on how good you are at making those decisions. All right, so where does all this stem from? Why do we make bad decisions? Why is this even an issue? Well, there are two parts of the brain called System 1 and System 2. And system 1 lives in the limbic part of the brain, the amygdala, the earliest part of the brain that was functioned a long time ago. You could think about in the prehistoric era when a human being was walking past a bush and there was a noise in the bush, people didn't want to say, reason out what was that noise. They thought, well, could be a lion or a tiger, I got to get away. So that's how the limbic system developed. It's reflexive, it's fast, it's automatic. You engage it all the time when you're driving. You don't think about making the turn signal anymore because it's part of what's going on in your system 1 thinking. A good example that I like to give is if I ask you all to imagine yourself on a great vacation. All of a sudden, something pops into your head. Probably at least half of you are thinking of yourselves on a beach with no shoes and a little umbrella and some fancy drink. System 2 is the opposite of this. It's not fast. It's not automatic. It's deliberate. It takes place in the prefrontal cortex rather than the limbic system. It's slow. It's effortful. And in contrast to that, thinking about your favorite destination, you would engage system 2 if I asked you, okay, well, plan where you're going to go on vacation, when you're going to take it, how you're going to finance it, all those things. That effortful thinking is system 2. And you can see it right here if you look on the screen and I ask you which one of these lines is longer. System 1 is tugging at you saying, well, the bottom line's longer, obviously. And then you think about it for a minute longer and system 2 engages and you say, wait a second, this is some kind of trick that this guy's playing, and those lines on the end don't really mean anything, and actually the actual lines are the same, and that's the correct answer. But you have to engage system 2 because system 1 wants you to make the mistake. So system 1 causes us to become cognitive misers. We don't engage in effortful enough thinking such that we often come to poor decisions. And this happens irrespective of IQ. There have been research that shows that people at the top universities in the country still make these same mistakes. And I've got a couple examples for you. So here's a word problem. Hopefully we haven't had too many beers from that beer garden outside and we could still engage in some of these. I think they're fun. I promise there's only a couple and you're not graded on them. So a tennis racket and a case of balls together costs $110. Racket, balls, $110. If the racket costs $100 more than the balls, how much do the balls cost? So, I think a lot of us want to answer $10. That's the system 1 thinking. But if you think about it and you engage system 2 and you consider it a little bit more, if the racket costs $100 more than the balls would have to cost $5, because 5 plus 100 is 105. So the racket is 105, $100 more than the balls being 5, added together is 110. So the correct answer is 5, system 2. System 1 wants us to say $10. A second question, which is maybe a little more scandalous, deals with whether a married person is looking at an unmarried person or not. So Alan is looking at Becky, but Becky's looking at Charles. So A is looking at B, B is looking at C. We know Alan, A, is married, but Charles is not. Yes, we don't know anything about Becky, but we want to know, is a married person looking at an unmarried person? So if you're like me, you read this and you said, I have absolutely no idea. They didn't tell me if Becky's married or not. I know Alan is, and I know Charles is not, but I can't figure it out, okay? But if you do something called subjunctive reasoning, and you engage system 2, you could test out the hypothesis of, if Becky's married, then what's happening? Well, then Becky is looking at Charles. A married person's looking at an unmarried person, so yes, a married person is looking at an unmarried person. If Becky is unmarried, well then Alan, who's married, is looking at Becky, and so the same thing is happening. So no matter what Becky is, whether she's married or unmarried, there's still a married person looking at an unmarried person. So the answer is A, yes. But again, that's not something that pops into our minds. We have to engage system 2. And this is the reason The fact that we're all cognitive misers and it's hard to answer these questions is the reason we all make these errors on a day in and day out basis, because we all don't have unlimited amounts of time to carefully consider every single option in all of these different questions that we're confronted in and day out. You know, because when you think about the quality of life is only made up by, how good our life is only made up by the quality of our decisions and luck. And so if we can improve the quality of our decisions, we're going to, I think, improve our lives and our investing. So this being a cognitive miser, reliance on system one, and these biases, they cause us to have these systematic biases in all our decisions. So I'm going to go through a few of them with you right now. In the interest of time, I won't do all of them, but so one is the herding bias. This is when we're unduly influenced by a group. You know, there's something going around, and all of our friends are doing it, and so we want to partake in it. This is kind of classic stock market problem, where you know, people like in the tech bubble in the late 1990s, this famously Newsweek summed it up with an "everyone's getting rich but me" on the front cover, and people wanted to partake and get wealthy like their friends, and so they bought the stock market, even though objectively speaking, it was very expensive at the time. The tech sector had gone from 25 times price to earnings to 50 times price to earnings, probably the most expensive it's ever been, yet people couldn't wait to buy more. That's because of this herding bias, where people wanted to kind of go along with the group. And there's been a lot of interesting academic studies about this, by the way. There's this really one interesting study many decades ago where they put a bunch of people in a room, and say there were 10 people in the room. 9 people were in on the experiment, and 1 person was not. And they put some lines up on the board, much like I had earlier in this presentation. And there would be a line that was clearly shorter than the other one, and they would ask all the people, you know, which line is longer or shorter, and 9 people would raise their hands and give the wrong answer. And most of the time, more than 50% of the time, the person who was not in on the experiment went along with the wrong answer, even though it was clearly wrong, because they looked at the other hands going up and said, "Oh, I must be missing something. Maybe I need glasses," or, you know, whatever it is. So that's the herding bias. Optimism bias, I see this a lot, not so much in my professional life, but in personal life when I'm talking to friends and acquaintances about investing. It's the tendency to forecast close to best case scenarios. It's probably one of the reasons, although we'll discuss another reason, why 90% of worldwide transportation projects underestimate the actual costs. We tend to forecast good case scenarios. A lot of individual investors, I find, like to try to kind of hit a home run, and so there's a lot of investing in more volatile stocks, I find. And it's funny, successful investing sometimes is the opposite of that. They've actually re-engineered why Warren Buffett's been so successful, and one of the reasons is that he's actually invested in less volatile stocks. You know, you think about boring consumer staples type companies that he's typically invested in, like Coca-Cola, you know, famously. Those companies are less volatile. Yes, you're less likely to get rich in them quickly, but you're more likely to compound over time. So sometimes the optimism bias can be a pitfall in investing. I'm going to skip this one in the interest of time. Loss aversion bias. This keeps a lot of us out of the stock market and out of making good investments because we don't value losses and rewards similarly. So a study was done that shows that the smallest gain needed to balance an equal chance of losing $100 is $200. So if you had equal chances of losing $100 and making $150, should you take that bet? The answer is yes. The expected value would be 50% times 100, 50% times losing 100, so minus 50, plus 50% times making $150, which is $75, and so gain of 75 minus 50 is an expected value of 25. Anyway, point is, if it's 50-50 odds and you can, and the reward is more than what you're going to lose, you should take that bet. The problem is that people needed a reward of $200 to take that bet, which is far too high, which kept them out of a lot of good bets, 125, 150, 175. Hopefully you get the point. So we all have a loss, many of us have a loss aversion bias. Availability bias. we probably all suffer from this one. I try to conquer this one, but I still fall prey to it. This is when we forecast based on the ease with which examples come to mind, or invest in things that are familiar to us. So I don't know the portfolios of everyone in this room, but I'm guessing that most of the portfolios in this room are weighted to US stocks because we live in the United States and that's what we're familiar with. But in fact, when we look at statistics, about 3/4 of Americans' portfolios are invested in US companies. But US gross domestic product is only about 1/4 of global domestic product. So we're actually really overweighted to the US relative to the rest of the world. And that's, I think, comes from availability bias. And I think this might be the last one, or the next to last one. Confirmation bias. This I think, is really prevalent now in politics, frankly. If you want to believe your party's the best, all you have to do is flip on the news channel now that tells you your party's the best and the other party is evil. Actually, studies done with respect to investing that many people make incorrect financial decisions, not because they don't have access to the right information, but because they reject or don't consider enough the correct information. So confirmation bias is another thing that works against us. And again, these are all part of System 1 thinking, where we need to kind of override these biases with System 2. All right, so that first half of the presentation is all the problems. Why we have these biases, biologically, where it comes from, how they manifest themselves, how they cause us to become misers with our thought making and cause us to make errors. The second part of the presentation is about fixing all this. So I hope you take notes. Maybe there's a couple things in here that can help you. They've helped me, and they come from people far smarter than me. If you want to read up on more of this stuff, I suggest reading Danny Kahneman, who's won all sorts of awards for his work in behavioral finance, Annie Duke, who's a fantastic poker player and author on decision making. So anyway, 3 different methods to help fix the problem. The outside view, I'll explain what that is in a moment. Focus on process, and think probabilistically. 3 things to help behave better, so to speak. Okay, so there's 2 different ways to approach a forecast or a decision. One is the inside view, and this is what most of us use most of the time. It's derived from our specific circumstances. So, we're thinking about our own experience with regard to investing in a certain thing, our own experience with respect to going on a trip, or how long it takes to get to the airport, etc. It uses our own evidence from our own experiences. It's qualitatively adjusted, so when we explain it to our family, our spouse, we're talking kind of, well, this is kind of what happened last time. You're not talking in statistics. And it accounts for known variables, and this is going to be really important. Obviously, you can only account for known variables, right? Because you only know, well, last time there was a traffic accident and made me this late, or I took this highway, whatever. But actually, if you use the outside view, amazingly, you can account for unknowns. And it's the only way that I know to account for unknowns. The outside view is derived from something called the base rate, which is, rather than using data from your own experiences, you use data from other people's experiences and evidence from other people's experiences. So it'd be akin to, if you've never gone on a particular route in your car, it's asking 50 people, or in this day and age, Google, how long does it typically take at 5 p.m. On a rush hour Thursday to get from here to there? That's the base rate. And then you can adjust it a bit because maybe that it's a holiday, and so the commuting doesn't apply, or what have you. But essentially, the outside view starts with a base rate, and it starts with other people's experiences and data, and the inside view starts with your own experiences and data. So here's an example. You're going to do a home construction project. You're going to remodel your bathroom. And if you were using the inside view, what would you do? You would talk to your contractor. You would have them lay it out in detail, How much is this going to cost? When is everything going to be done? You could even have milestones. That's accounting for all the known variables. But what you don't know there is what happens when your contractor's child gets sick and he has to take a week off, or there's some kind of weather event that was unforeseen, or the supply chain doesn't work as fast as the contractor thought. You can account for those kinds of unknown variables using other people's experience in the same project, because over time and with a lot of data, those kinds of unknown variables get factored in. So you would, in this particular example, you'd aggregate the data of what we call the reference class, which is other people's products, to determine kind of a cost per square foot, or how long it takes for a typical project like this. And then, like I said, you would adjust the baseline estimate by the specific circumstances. If you were digging a foundation, do you have rockier land or not, then the base rate, which is other people's experience. Example I like to give here is Steph Curry, one of the best shooters to ever live in the NBA. Yes, I like sports analogies. If he's flipping a coin, the base rate for flipping the coin is 50-50. And we don't have to adjust, even though it's Steph Curry flipping the coin, we know that it's going to be around 50-50, right? Because there's a lot of, there's no skill involved in flipping a coin. The more skill there is involved in the particular decision or forecast that we're making, the more you want to adjust. So if it's Steph Curry shooting a foul shot, do we adjust the mid to high 70s that the NBA shoots on average at the foul line? Yes, of course we do, because it's Steph Curry. He's the best free throw shooter of all time. He shoots 92%, so you have to adjust it up. So anyway, we always start with the base rate. In the free throw shooting example, it's the mid 70s, and then we adjust up or down. So that's the way we make decisions using the outside view. Okay, so the second thing is to focus on process, not the outcome. So we just went through this whole Super Bowl 49 example, right? And just 3 years later, a similar play call at the goal line was deemed to be one of the best calls ever, whereas the one that didn't work out was called one of the worst calls ever. What's the difference there? It's not the data that goes into it. It wasn't the process. It's the result. And so this is what we call resulting, when you draw an overly tight relationship between the results and the decision quality. And we'll talk about some of the ways to avoid this, but you've got to write down the process so you can evaluate the process rather than the outcome. A good outcome shouldn't be used to reinforce bad behavior. For instance, if one of our children went out drinking alcohol, and they came in the door, after midnight, and they said, "Great news, Mom, Dad, I drank all night and I got home safely." We wouldn't say, "Oh, that's fantastic, little Johnny." We would say, "That's the dumbest thing you've ever done. Do you know what could have happened? The result was fine, but the process was terrible." So you've got to grade the process, not the outcome. You also need to think probabilistically, because life is not like chess. There's luck in life. And we have to account for maybe luck didn't go our way, maybe luck did go our way. Life is a lot more like blackjack. We all know you're supposed to hit on 11, but sometimes it doesn't work out. Conversely, somebody who doesn't know blackjack that well may hit at 17 and get lucky, and it may work out for them. But it's not something that we would advocate doing time in and time again, because the math doesn't suggest that it would work. So to drive this point home is a game that I like to play with my kids at home. It's called Colonel Blotto, and the way the game goes is, two players play. They're given each 100 soldiers, and those soldiers are divided up into 3 battlefields. Now you divide them up separately, so the two people who are playing, they don't tell each other how they're dividing them up. So you could divide it up 50, 48, 2, whatever you want, to the 3 different battlefields. And then once they're divided up, you then play. What'd you have for Battlefield 1? And you flip over your piece of paper, and you see who won. You do the same thing for Battlefield 2 and Battlefield 3, and you see who won. So in this example, I'm playing with my friend Adam. I do 45 on the first battlefield, 10, 45. He doesn't see that, of course, and he takes the more traditional route of 33, 33, and 34. And you see here that I outsmarted him by varying it a little bit. I won Battlefield 1 and Battlefield 3, and so I won the game. I won 2 out of 3. That's not that interesting. Cool game to play with your kids maybe, but not super interesting. But here's what I find really fascinating. How much more would a player win if he or she had 25% more resources, meaning 25% more soldiers? So if we were playing this game and you had 100 soldiers and I had 125 soldiers, how much more would I win? What if I had 200 soldiers and you only had 100 soldiers? It seems like I'd win all the time, right? How could you beat me? I got 200 soldiers. I guess it's possible that you could put, 100 of your soldiers, or you could do 98, 1 and 1, and maybe I was silly enough to do, 97 and 0, and so it's possible that you win. Anyway, in using computer simulations, we find that if you have 25% more resources in this game, you only have a 60% win probability. And if you have 100% more resources, 100% more soldiers, 200 soldiers, you have a 78% win probability. So, yes, your probability goes up, but it's not foolproof at all. Think about investing. It is extremely difficult. Believe me when I tell you, it's extremely difficult to have a 25% edge on the rest of the market. These are the very smart men and women trying their hardest to outsmart the market day in, day out, with all the best resources money can buy. If you are 25% smarter than them, you still only have a 60% chance of winning. So that means you're going to lose a lot of the time, even when you're making the right decision and are really well prepared. And that's why we have to think probabilistically, because we're not going to win all the time, even if we're doing the right things. We have to be prepared for losses. And if we're not prepared for losses, then we're going to run into trouble. So we have to allow some leeway for that and think probabilistically. So one of my favorite examples of thinking probabilistically and how it can run into a problem actually making bets was done by a couple of gentlemen. One of them actually was one of the people who ran long-term capital management, if you remember that spectacular blow-up. It was by a bunch of Nobel Prize winners who ran a hedge fund, and who knew what could go wrong, but the hedge fund famously blew up in the late 1990s. Anyway, in proving how important decision-making is and sizing and investing, they did a simple experiment. They designed a computer program to engineer a digital coin flip. And the coin, instead of being 50-50 heads, tails, is 60-40. So it's programmed 60% to land on heads and 40% to land on tails. And they recruited a bunch of people for this experiment, and they told them, this thing is rigged. It's going to land 60% on heads. We're going to give you a certain amount of money and let you bet on this. This is with real money. And you just pick how much you want to bet each time, and we're going to actually pay you out however much you win up to, I forget the max, $200 or $250. You get to keep the money. And so they run the experiment, and this is what happens. A third of the people lose money. 28% actually go bust. They lose everything. And only 21% max out at over $200 winning, even though the math says that if they bet the correct amount, everyone would max out. Statistically, it's almost a sure thing. So you ask, what is the correct amount and what do these people do wrong? Well, the correct amount to bet in this case is shown by something called the Kelly criterion, which you don't have to memorize this, and I'm not really advocating you use it in your daily lives, but it was created by this smart mathematician investor named Jim Kelly, and he said that 2 times the probability of winning minus 1 is how much you should bet. So 2 times 60% is 120% minus 1. That means you should bet 20% on each flip of the coin to max out your winnings. So if you just bet 20%, you would end up with over $200. But what did a lot of people do? They bet erratically, they bet too much, and if you bet too much, just as we saw in the Colonel Blotto game, if you bet too much, even if the odds are with you, you could still go bankrupt. And that's what happened to a lot of these folks. They didn't bet consistently, they didn't have a framework, and they lost money. So you need to think probabilistically. So tying all this stuff together in terms of fund selection, I find that too many investors invest based on performance. And we know that short-term performance is not a good way to make decisions about stocks or funds. In fact, if you knew nothing else about a fund, you'd probably want to pick funds that have poor 1-year and maybe even 3-year track records. They've been shown academically to do a little bit better than funds that are hitting the lights out with a 1-year and 3-year. So here I've advocated kind of a different framework, which maybe with the help of your financial advisors, you can help implement. But it advocates not looking at the performance of a fund, but looking at the fundamentals of a fund. And so you can see there's 4 different quadrants. If the fundamentals of the companies that are in the fund are performing poorly and the performance is doing poorly, that's in the top left quadrant. That's a candidate to sell. If the performance, the return is positive, but the fundamentals are not good, that's the bottom left quadrant. That's also a candidate to sell. Conversely, if the fundamentals are doing well of the company, so the earnings are growing, et cetera, but the stock prices of the fund are not keeping up, that's a candidate to add. And if both are doing well, that's obviously a candidate to hold. But I see too often people making decisions simply because a fund is down that they want to exit it. And I think that there's another layer to look into there to make better fund selection. But the point here is to at least have a process rather than using system 1 and making kind of a knee-jerk reaction. So tying all this stuff together that we've talked about, how do you behave better, make better decisions? Well, 1, you need to establish sound processes. You have to use system 2, override your system 1, limbic thinking, and use base rates. What is the typical experience? So say you want to think about how am I going to do in the stock market over time. You don't think in a vacuum that I'd be happy with X percent, or the last 5 years the stock market went up Y. What you do is you look over time, over history. That's the base rate, how much the stock market goes up. Then if you want, you can adjust that base rate based on whether interest rates are lower or higher, or a multitude of other things, just like we adjusted up Steph Curry's chance of making a free throw. You can adjust it up. But the point is that you have to start with a base rate and actual statistical data from history. That's the process. You should ensure repeatability. You have to create guidelines or automated processes using a checklist or even better, software, so that you can go back and grade the process rather than simply grading the outcome. So that has to be documented. So if you're right for the wrong reason, that's not a good thing, and that can lead to a bigger mistake the next time if you get more overconfident about it. And you have to grade yourself over time. You can't, go to your financial advisor and say, well, this 6-month period was terrible, or even this 1-year period was terrible, because we just saw you could be doing the exact right thing and have a bad result for a short period of time. So you have to look at how volatile things are, what that means about probability. Like I showed you what it meant for the Colonel Blotto game, and how often you could be wrong. But the more volatile something is, the more you have to think probabilistically, and the more you might have to endure a bad outcome or two along the way. So I told you I'd get pretty specific for investing decisions in particular. So here are some specific things to do. Do put your investment goals in writing. I just mentioned earlier, don't chase returns because you'll be disappointed because recent past performance isn't necessarily indicative of future results. In fact, it's often not. You should assign short and long-term time frames to those goals that you make. You should evaluate several scenarios as potential outcomes. What happens in a bad case, what happens in a good case, rather than, we said a lot of people are overconfident, and 90% of infrastructure projects take longer than were planned. So you should evaluate different types of scenarios. And you should build your portfolio using an agreed-upon asset allocation framework that helps take out the emotional biases, so you don't wake up feeling, oh gosh, I'm scared. You stick to a plan, and the plan has been vetted, and you've decided on the plan. You should not use your gut you should not make investments outside of the framework you establish, and you should not use your gut to make decisions, because even if it's successful, it's hard to make it sustainable and repeatable. So at the end of the day, obviously, it all boils down to implementing and sticking to a game plan and a process. Just a quick word about what we do at Alger. So obviously, we are fund managers. We manage over $20 billion. We've been doing it since 1964. We invest in growth equities. Fred Alger, who started the firm, was one of the pioneers in growth investing. To make better decisions, we do think about probabilistic valuation. Every single time we recommend a company, a stock for purchase, we don't just say it's going to go to this price target and say, sorry, we're wrong if it didn't work out. We have a bull case, a base case, and a bear case. So we think probabilistically about what could happen under different scenarios. We try to have different inputs for thinking about making these decisions. So it's been proven that the stock market runs into trouble and gets into a bubble when there's homogeneous decision makers, when everyone's thinking the same way. In other words, the same story is making the rounds, and everyone is making the same types of decisions based on the same type of information, same type of story and data. We try to have a diverse workforce, so you have people with different experiences and different data that they bring to that decision-making process. We do that by trying to have people, not just diverse ethnicities and genders, so we do have 50% women or minorities in the portfolio management seats, but also just from different walks of life. Not everyone should be a Harvard graduate. Not that there's anything wrong with being a Harvard graduate, it's great, but you probably don't want all Harvard graduates from a particular socioeconomic area making your decisions in investing. And you should have a culture that promotes openness and flexibility of thought. Being able to admit that you were wrong or listen to a different piece of information, I think, is really important. Having free-flowing exchange of ideas, having offices where the doors aren't shut, where they're glass, you could see people. These are all things that we implement. So just summing it up for you, economics assumes that we all have rational behavior, but humans don't always act rationally. And that's because of the way we're wired, and we need to actually implement different processes for avoiding our own pre-existing biases. You can use the outside view, focus on a process, and think probabilistically, in my view, to make better decisions. And with that, we'll open up for questions.
Here's a question. I'm assuming the majority of stock market investments are made by institutional rather than individual investors. But if that's so, you would assume they would be more free from emotional decisions. But we see very small stimuli like a Fed decision or some bad news will immediately trigger a dramatic change in the market. How do you explain that?
Okay, I don't know if everyone heard the question because I know we're streaming this. The question was, if institutions control most of the money in investing, why do we still see these knee-jerk decisions being made or bad decisions being made? So I'd say a couple things. One, we do find a bigger gap between a bigger underperformance gap in retail investors than institutional investors. So if you look at overall active managers do underperform their benchmarks, but we find in some of the data I presented that retail investors underperform their underlying investments more so than institutional investors. So I do think retail investors are impacted a little bit more by behavioral biases. That said, I have some bad news for you. Institutional investors are humans. And having been an institutional investor, I know, when I don't actually pull the trigger on investments anymore. I do this for a living. But when I was actually investing, and I had a boss who's yelling at me that we're going to get redemptions or, this stock can't be down, right now, you've got to make money. And I actually literally had a boss who would show me every 6 months the best stocks out of 200 in my sector that did better, than my picks. And that, makes you on edge, and you make bad decisions because of that. So I think a lot of institutional investors suffer from this. Warren Buffett is a great one who may be more free of these biases than the average investor, but a lot of us fall prey to it. So it's something that everyone has to work on. And the last thing is, just because there are knee-jerk reactions does not mean that those reactions are irrational. Sometimes a new piece of information that can come out that is quite rational. For instance, if God forbid there was a new COVID variant found, it may make sense for the stock market to drop very significantly and for drug companies, to go up. So the market tries to process these things very quickly, but I think you're right, and we all suffer from biases, and I think we're going to struggle with it, to the end of time. Any other questions?
Yeah, I don't know how to phrase this, but when you're talking about an outside process, isn't that hard to do for a given stock because of outside forces that are hard to predict, like a war in Ukraine or
Yeah, so the question is, isn't employing the outside view hard to do for a given stock? And I agree, it's harder to do for an individual stock than it is for, say, a basket of stocks like the S&P 500. I think it's a lot easier to use a base rate and outside view than it is for an individual stock. That said, base rates can be very helpful with individual stocks. Sometimes, for example, people get very excited about the latest, greatest innovation. Like I'll use something like I don't know, cryptocurrencies maybe. Well, using base rates, you might look at what has been the historical adoption of technologies like that over time, and you might see that yes, this company could grow 40% a year. I'm making this up. Like investors, like the consensus thought it would a few years ago, but that would be very rare for any kind of company to grow that fast. So that's where a base rate would come in. You can override that and say, this is really a once-in-a-generation technology. Maybe that's the case with artificial intelligence, but you should at least know that the base rates say that only, say 5 companies in history have ever grown 30%, I'm making this up, but 30% annually over a decade. The base rate would have saved you a lot of money by showing you that maybe some of the forecasts for many other companies were too high. So that's the way to use base rates. Yes, sir?
What is your recommendation on annuities?
Well, I'm not allowed to give recommendations in general. Annuities are a broad subject because they could be fixed, variable. So I won't get into that one. We could talk offline though about stock market. But again, I would employ base rate. If it's tied to the stock market, I would think about what the stock market historical returns have been, and then I would adjust it. And what I personally would adjust it based on is Warren Buffett says the greatest predictor of the future returns of all asset classes is the long-term bond. And so if the long-term bond, even though it's run up a lot recently, is lower than history, that signifies that you're going to have lower returns than history. And actually, if you go to alger.com and look at a presentation that I put out each quarter called the Capital Markets Observations Insights, we have what I think is a really good one-page kind of base rate on stock market returns. And it turns out that there is an R-square of 85% between the starting price-to-earnings multiple of the stock market and the forward 10-year return. In other words, the variability in 10-year annual returns is solely based on the beginning price-to-earnings multiple. So when you look at that page, you can see what a given price-to-earnings multiple equates to for a long-term return. And right now, sitting at like 17 times earnings, it equates to something like a mid-single-digit annual return. And so you can see if that makes sense in your annuity. All right, thank you very much.
Yeah.